Welcome to this Killik Explains finance video. This week, a quick look at an old stock market cliche, and I'm going to suggest that investors shouldn't follow it. It's sell in May and go away. Now, this is being filmed in June, alright, so if you followed this, you'd have done it last month, but I'm hoping that you didn't. And here are the reasons. If you've not heard of it, let's do a quick recap first. Now, the overview is basically what? Well, essentially, where does this come from? It's an old stock market cliche, and there are several of these sort of what are now becoming old wives' tales around, but you may have heard of this one. It's an accepted piece, or was, of US stock market wisdom that urges investors to sell in May, and then what? Well, basically, you decrease your exposure to equities in May, go away and have a nice summer holiday, and buy again on St. Leger's Day. So it is a US stock market cliche, this one. That's a famous September horse race. So the idea is, without being too date precise, you dump your stocks at the start of the summer and regroup and buy them all back at the end of the summer. And the theory being that in the meantime, all the big money will have retreated, gone off to the Hamptons or whatever, taken its money off the table. That means the summer stock market will lull. So you want to be out of it then, take your gains off the table made in the spring and get back in just before what you hope will be the push to Christmas. Sounds good. Problem is, as amongst others, Charlie Bellello, the Director of Research at Respected Pension Partners, points out, this is bad advice for several reasons, particularly for retail investors. The main one is the historic US stock market data. We're going to look at the US stock market because the cliche originates from the US, if you like, in this instance, doesn't really support the idea. And he's looked back over quite a long performance period. Now, there are lies, damn lies and statistics, so other people will select data that tries to make the point that it does work, but his data is pretty convincing, as you'll see in a moment. And another is, it's an example of market timing. We don't like market timing. I don't like market timing because it's stressful. If you get it wrong, the costs are considerable, and it introduces frictional costs even if you get the direction right. And I'll come back to what I mean by that in just a moment. So here it is then. What are the problems with selling in May and going away, buying back on St. Leger's Day? Well, number one, a smaller gain is still a gain. What do I mean by that? Well, basically, the first slide looks at S&P 500 total returns over a long period, 1928 to 2018, total returns, that's income and capital growth if you like, and what you notice is this. Here's May to October, sell in May and go away, that's the period you're out of the market if you like. Here's November to April, that, following the old cliches, when you're back in the market. You might say, well, there you go, job done, point proved, because clearly if you're looking at, say, the average return, well, it looks better, whether you're looking at average, pure average or median, to be on the right-hand side of the slide, surely. But the point is this, you're making a positive return, whether you're on the left-hand slide or the right-hand side of the slide, if you like. And a positive return is worth having. Why would you leave the market not to get it, if that makes sense? Or realistically, do you think you could do better out of the market than what's on offer on the left-hand side? Now, the past is no guarantee of the future. This is historic information, I should stress that, but a reasonable point nonetheless. Number two, the odds don't change much. What does that mean? Well, and you can cut this cake a number of ways. Here's another way of looking at it. If you were to take S&P 500 again over that long, always 1928 to 2018, all right, and look at the percentage of positive total returns, again, May to October on the left, that's when the cliche would say you're out of the market, and November to April on the right, when you're in it, if you like, hence the sort of pink and the green, you find something quite interesting, which is, yes, the percentage is higher. You can see it there, 73.3 on the right-hand side. All right, so higher there than over here, which is 71.1%, just to make it a bit bigger. So you might say again, well, the right-hand side is better. November to April is better. Yeah, but not by an awful lot, okay? So you're still making, or the chances are you'll still make a net positive return most of the time, whether you're invested between the November and April months or the May to October months, past being no guarantee of the future. All right, this is based on historic data. Now, the big compounding effect. Now, this is quite an important one. So, point three here, if you like, is this. If you were to look at the total growth of $10,000, again, same performance period, S&P 500 once again, all right, and you were to compare a strategy of selling in May, taking your money off the table, waiting, going back in again, with simply buying and holding. Here's the thing. Although the returns between May and October looked smaller, all right? And although your chances of making a positive return are slightly smaller, nonetheless, if you miss out on all of those over an enormous performance period like that, the difference is pretty spectacular. At the end of the period, 2018, you'd be looking at around £2 million, or $2 million I should say, not bad, all right, from rolling your 10,000 through that strategy of sell in May, go away, back again in October, versus around 33 just following buy and hold. Come back to that briefly in a moment. Why this happens, again, this is the final point really, is this. So this is a wall of information. You might be thinking, Greg, don't like the look of this much. But what he's trying to do here is to say, if we look at S&P 500 average annualized forward total returns, easy for me to say, 1928 to 2018, same performance period again, and we look at these on a monthly basis over a 1 year, 5 year, 10 year, 20 year, and 30 year period in each case, what do you see? Well, you see some differences. Here's the point really. Rather than trying to read every number in this table, what you'll notice is something about the numbers in this table. They're not terribly far apart. Now, what does that mean? Well, yes, ideally, you would get, let's say, if I was to pick one of these months, you would get 11.5% rather than 11.3%, let's say. Who wouldn't want that? Or if we were to pick, let's say as another comparison, let's go for a summer month, 11.6, all right, is better than, let's say, 11.2, all right? So the point being, yes, there are months on this basis which are stronger than others, but the difference actually isn't that significant. And the point being, that if you're out of the market on almost any period basis, you could be missing out on a positive return. So yeah, your market timing was spectacular. Being in and out on specific months could make a difference. But do you fancy your chances of getting it right? And also another thing you'll notice is that there's no obvious noticeable lull, certainly not a huge one, in those summer months. Remember I talked about out in May, back in again in October if you like, compared to looking at the period you'd be in the market following this old cliche, November through to around sort of April time. And that's his point. So don't worry about the wall of numbers. Don't try and sort of read them from a distance. It's more about the principle. Conclusion, therefore, well, 3 things. Market timing, as we know from other videos, can be hazardous to your wealth. Number 2, that's because no single month shows a persistent pattern of out or underperformance. So there is a bit of market timing you could try and do, but it's frankly not worth it. Luck more than judgment. And buy and hold beats sell in May and also reduces emotional stress. If you get it wrong, imagine dumping all your stocks in May and then missing out on a gain, for example, and of course frictional costs, trading costs, even capital gains tax when you sell, for example, and so on, stamp duty when you buy the shares back. So there you have it. To email me on a big topic, editor@killik.com, and to watch related videos that explore 1 or 2 of these aspects in a bit more detail, it's killik.com/learn, and I'd go for this one to the shares tab.